if you have money sitting in a bank account right now, just earning nothing, growing nowhere, you probably think you are being safe.
Right. You think you're being responsible.
Yeah, exactly. But what if you are actually, slowly losing a war that you don't even know you are fighting?
It's a profound illusion of safety. And the immediate casualty of that illusion,
The first thing to go.
the very first thing to go is your future purchasing power, followed very closely by your ability to actually influence the world around you.
Yeah, and that is why today's deep dive is such an urgent one. We are unpacking a highly strategic financial manifesto aimed specifically at Western Muslim investors.
Right. It's a fascinating document.
It really is. It's a complete breakdown of how the wealthiest entities on the planet, specifically sovereign wealth funds, operate in a completely different reality than everyday savers.
A totally different playbook.
Exactly. And it outlines how millions of people are falling into this silent wealth crisis. So, okay, let's unpack this. The core problem identified in our source material is what it terms the lazy money trap.
The lazy money trap. Yeah.
And the numbers attached to this are they are absolutely staggering. There are approximately $3.9 trillion sitting in non-interest-bearing deposits in the United States alone. Trillion with a T.
Yeah, and that $3.9 trillion, that's where the paradox really begins.
Right.
Because that figure represents millions of Muslim Americans who made a conscious ethical decision.
They made the righteous choice.
Exactly. The righteous choice to avoid Riba, which is, interest or usury.
They wanted to keep their money clean.
Keep it clean and stay entirely within Sharia-compliant standards. But the painful irony the manifesto points out is that by leaving that clean money entirely idle, it is being invisibly, relentlessly destroyed by macroeconomic forces.
Okay, I want to stop you right there and play devil's advocate for a second.
Sure.
Because I think a lot of people listening might be confused by that. How is it that following strict ethical standards is leading to what our source actually calls a generational wealth crisis?
It sounds contradictory, right?
It does. Doesn't ethical non-interest banking imply safety? If you avoid the shady, speculative, highly leveraged stuff that, blows up Wall Street every 10 years.
Right. The toxic asset.
Yeah, the toxic stuff. Shouldn't your money just sit there perfectly preserved?
Well, in a static world, perhaps, but we live in a dynamic economy that is entirely driven by inflation.
Right.
What's fascinating here is how the source describes inflation's mechanics. It doesn't announce itself,
Like warning bells.
Exactly. It doesn't send you a warning letter in the mail saying, hey, we are taking 4% of your wealth this year to cover the national debt.
That would be nice, but no.
It just silently dilutes your purchasing power.
Yeah.
Every single year that your capital sits still, it buys less. It commands less influence in the market.
It reminds me of a metaphor. Think about it like a guardian who is entrusted with a massive pot of really hearty, nutrient-dense soup for their family.
Okay, I like where this is going.
Right. But instead of actively adding more meat and vegetables to keep it rich as the family grows, the guardian just keeps pouring tap water into the pot to make it look full.
Right, just watering it down.
Yeah. Sure, the liquid still reaches the top of the bowl, so it looks like nothing was lost, but there's no nutrition left. The value has been completely diluted.
That is an incredibly accurate way to look at it.
By trying to keep the money perfectly safe in a zero-yield account, you are just pouring tap water into your own wealth.
Yes, inflation is active dilution. So what felt like immense discipline to the everyday investor, refusing interest and keeping the money clean,
Right.
it has transformed into this lazy money trap. Clean money that does absolutely nothing is still money that is losing its underlying value on a daily basis.
Which is just a terrifying realization for you as an investor.
It really is.
You feel like you're doing the moral thing, but the math is secretly working against you. Now, our source material makes a really sharp pivot here, which I found super interesting.
Yeah, the shift in focus.
Right, it contrasts the everyday investor trapped in this cycle with global elites. We are talking about the massive institutions and families documented in the Muslim 500, the sovereign wealth funds of Qatar, the UAE, Saudi Arabia.
The heavy hitters?
The heavy hitters, yeah. They are ostensibly playing by the exact same ethical rules, but they are absolutely not suffering this fate.
No, they aren't. Even during periods of intense global economic uncertainty, their portfolios aren't just surviving the inflation drain.
They're compounding.
They are compounding massively. And the source argues that the reason isn't simply because they sit on oil reserves.
Right. It's not just the oil money.
No, and it isn't just because they have state-level political power either. It actually comes down to a fundamentally different psychological relationship with capital itself.
The text mentions they don't view wealth as a status symbol.
Yeah.
Like they don't view it as a trophy or just a high score to gaze at on a bank statement.
Exactly.
They treat wealth as an amana.
Yes, an omna.
I try.
A trust. That is the single mental shift that changes every financial decision that follows.
Because if it's a trust,
If your wealth is a trust, you are not its absolute owner. You are its steward.
Right.
You have a fiduciary duty to whoever or whatever that trust is meant to serve. Your family, your community, your future legacy.
so treating wealth as an amana means you're acting like an active portfolio manager, not just a hoarder.
Precisely.
If you view your capital as a trust, letting it evaporate due to the dilution of inflation is a direct failure of that stewardship.
A total failure. You have a duty to maintain its strength and its utility in the real world.
So the question the manifesto poses is, how do the wealthiest allocators protect and grow this trust without violating their ethical boundaries and crossing into Riba?
Right. How do they do it?
Well, the source breaks this down into a specific architectural strategy, 3 main pillars.
Okay, so if locking cash in a vault or a checking account guarantees a loss, what is the alternative? Because you can't just throw it into Wall Street derivatives or, leveraged hedge funds. No, you can't, which is exactly why Pillar 1 is so crucial. The wealthiest allocators pivot entirely to scarcity assets.
Scarcity assets.
Yeah, they do not chase yield in financial instruments that depend on debt cycles or paper promises. They position their capital into physical reality.
So we are talking about gold, silver, real estate, land.
Intangible commodities, yes.
Things that central banks cannot just print out of thin air when they decide they need more liquidity in the market.
Exactly. When fiat currency weakens, when that tap water is poured into the soup, as you said earlier,
Right.
scarcity assets inherently hold their ground because their supply is physically restricted by nature, not by government policy.
Right, they can't just invent more land.
Exactly. When global markets panic, physical value remains. And this isn't just some informal hedge strategy, by the way. It is highly codified.
How so?
The source points out that the AAOIFI, the Accounting and Auditing Organization for Islamic Financial Institutions...
That's a mouthful.
It is, but they are essentially the global standard-setting body for this stuff. They have built massive frameworks around asset-backed transactions for exactly this reason.
Okay, let me make sure I understand the mechanics of that. Asset-backed transactions mean that every dollar moving around has to be tied to something you can actually touch or verify. Right.
Yes. The underlying principle is to completely eliminate leverage built on speculation.
Okay.
In conventional finance, a bank might hold $1 in reserve and lend out $10 based on the assumption that not everyone will ask for their money back at once.
Right, fractional reserve lending, which works until it doesn't.
Exactly. It creates systemic fragility. But the Islamic financial architecture demands that capital is anchored to reality. Real assets, real risk, real value.
Real value. Okay, I see the logic. But how does you, the individual listener, actually apply this?
That's the big question.
Because it's easy for the Sovereign Wealth Fund of Qatar to buy up thousands of acres of agricultural land in Europe or tons of physical gold. It sounds like a billionaire's game.
Sure, it does.
If I have $50,000 of lazy money, I can't go buy a commercial skyscraper in Manhattan.
No, you can't, and this raises an important point about scale. The source is very clear on this. You do not need a sovereign wealth fund to apply this architecture.
Okay.
You just need the strategy because the underlying principles scale down perfectly. It starts with moving a designated portion of your idle fiat capital into unprintable assets.
So breaking it into smaller pieces.
Exactly. Today, the tools for fractional ownership are highly developed. You can invest in real estate investment trusts that are Sharia-compliant.
Right.
You can acquire physical precious metals. You can participate in asset-backed commodity funds. The operational goal isn't to buy the whole skyscraper.
It's just to own a brick of it.
Yes, to anchor a percentage of your wealth to the physical reality of the market, shielding it from fiat dilution.
Okay, so that handles defense. Pillar 1, moving into scarcity assets, is how you stop the invisible bleeding of inflation.
The bleeding, yes.
But a true steward of an AMA can't just play defense forever. To be an effective guardian, that trust has to grow.
You have to go on the offensive.
Right, you have to go on the offensive. And here's where it gets really interesting, folks. Pillar 2. The manifesto outlines how these elite funds are positioning for the next major economic power cycle,
Yeah.
specifically pointing to a massive shift expected to solidify around 2026.
The 2026 shift. The document provides a fascinating macroeconomic view here. It outlines that we are currently witnessing the end of one economic era and the beginning of another.
The end of the software era.
Exactly. The last 10 to 15 years were entirely dominated by the SaaS economy, software as a service. Think cloud computing, subscription apps, social media platforms.
Everybody was building an app.
Everyone. But that model is maturing. The margins are shrinking.
Right.
The next massive wave of economic dominance isn't going to be software apps. It is going to be the foundational layer beneath it. Power generation, AI compute, and robotics.
We're talking about heavy energy infrastructure, artificial intelligence server farms, automation systems.
Yes.
But wait, I have to jump in here and push back on this because it sounds totally contradictory to Pillar 1.
How so?
We just established that the core rule is focusing on real value and avoiding speculation.
Yeah.
Isn't investing in AI and robotics right now incredibly speculative? I mean, fiber optic cables and the dot-com bubble of the late 90s were considered infrastructure too, right? And that crashed horribly.
It did.
How is buying into AI tech today any different from the telecom crash of 2000? Doesn't chasing this tech trend completely violate the ethical rules of avoiding excessive risk?
That is a very sharp comparison, and it's exactly why we have to look at how these funds are investing, not just what they're investing in.
Okay, lay it out for me.
The source specifically reframes this. The sovereign wealth funds aren't buying into the hype of consumer AI apps or, speculative tech tokens that might disappear in 6 months.
So no random AI crypto coins.
No, absolutely not. They aren't venture capitalists throwing money at 100 startups hoping one survives. They are investing in the physical foundational infrastructure.
The nuts and bolts.
Exactly. They recognize that AI compute and massive energy generation are the new digital concrete and steel.
Oh. Okay, so they aren't betting on which specific software company will win the AI race.
Yeah.
They're literally buying the power grids and the data centers that any winning company will be forced to rent.
Exactly. It's the picks and shovels approach. Even if a specific AI product fails, the overall demand for processing power and electricity only goes up.
Right.
And the capital flows documented in the source prove this isn't a guess. The major Gulf sovereign wealth funds, specifically Mubadala, the PIF in Saudi Arabia, and the QIA in Qatar,
Yeah.
they are deploying hundreds of billions right now into AI infrastructure and energy technology.
Billions.
Hundreds of billions. They are positioning themselves at the bedrock of the next global power cycle before the mainstream retail market even understands the shift.
Okay, but again, I have to bring this back to the individual listener here.
Of course.
If you are sitting at home looking at your savings, you are the PIF. You can't go buy a nuclear power plant or a massive AI data center.
No, you can't.
And if you want to stay Sharia compliant, you can't just log on to a brokerage and buy heavily leveraged tech stocks on margin either.
Correct.
So what is the actual mechanism for you to participate in this 2026 infrastructure shift ethically?
Well, the structural tools already exist within Islamic finance, and the source highlights two specific mechanisms for Pillar 2, Musharaka and Mudaraba.
Okay, let's break those down. How do they actually work in plain English?
Think of the fundamental difference between a conventional bank loan and an equity partnership.
Okay.
In a standard Wall Street model, a bank lends a business money and demands a guaranteed 5% return, regardless of what happens.
Right, they get paid either way.
Yeah, exactly. If the business succeeds and makes millions, the bank gets its 5%. But if the business fails and goes bankrupt, the bank still demands its 5% and liquidates the owner's assets to get it.
Which is brutal.
It is. That structural imbalance, that guaranteed return without shared risk, is Riba. It's exploitative.
So how does Musharaka fix that?
Musharaka is a true, equitable partnership. You are sharing the actual risk of the enterprise.
So you're in it together.
Yes. If you invest in a fund building an AI energy farm, and that farm turns a 20% profit, you share in that exact upside.
Nice.
But crucially, if the project faces delays and loses money, you share the loss proportionate to your capital. The money is directly tied to the reality of the business, not a guaranteed paper promise.
Okay, and what about Mudaraba?
Mudaraba is similar, but it specifically structures a partnership between someone providing the capital.
Like our listener with the lazy money.
Exactly, and someone providing the labor and expertise, like a specialized fund manager.
That makes perfect sense. It aligns the incentives. I
Yeah.
mean, the manager only makes money if the investor makes money.
Yes, and because of the rise of specialized compliant investment platforms in the West right now, an everyday investor can actually allocate capital into these exact types of infrastructure funds using these structures.
Oh, wow.
Yeah, the architecture is there. What most people lack, according to the manifesto, is the awareness that they even have access to it.
Which is why we're doing this deep dive. Okay, so we have a clear two-part strategy so far.
Yeah.
First, defense. Pillar 1, moving out of idle fiat and into scarcity assets to stop inflation dilution.
Right.
Second, offense. Pillar 2, using equity-based risk-sharing partnerships to capture the massive infrastructure growth of the 2026 power cycle.
Defense and offense.
Exactly. And honestly, that sounds like an incredibly solid, comprehensive financial plan just on its own.
It is a great plan.
But the source material introduces a final element, Pillar 3. And this is the part that takes this from a standard, very smart Wall Street playbook and elevates it into a uniquely enduring, centuries-old economic strategy.
Yes. If we connect this to the bigger picture, we arrive at the Baraka factor.
The Baraka factor.
And the author argues that this is what separates mere financial accumulation from true multi-generational legacy building.
The source quotes an authentic hadith here. It describes a very specific methodology of giving, where the right hand gives and the left hand does not know.
Yes.
It's an allegory for total anonymity, consistency, and absolute sincerity. But what blew my mind reading this manifesto is that the author doesn't frame this as just a soft, spiritual aside to make you feel good.
No, not at all.
They present it as hard, observable economic strategy.
Because historically, that is exactly what it is. If you study the financial histories of the most enduringly wealthy Muslim families and dynasties over the last millennium, a very clear structural pattern emerges.
Okay, what's the pattern?
Wealth that circulates through mandated mechanisms like zakah, voluntary sadaqah, and strategic waqf, it does not diminish over time.
It doesn't run out.
No. Historically and economically, that wealth actually compounds.
Okay, I need you to prove that for me and for the listener. Because on a basic mathematical level, giving money away means you have less money.
Right. Basic math says 10 minus 2 is 8.
Exactly. How does giving capital away systematically make a family or an institution wealthier?
We have to look at the macroeconomic network effects of these institutions, specifically waqf, which are essentially irrevocable charitable endowments.
Okay,
Let's look at a historical example from the Ottoman era.
let's hear it.
A wealthy family doesn't just hoard gold. They establish a waqf to build and permanently fund a massive public market, a hospital, or a university in their city.
Right, so they tie the capital up in a permanent trust for public good.
Exactly. Now, what happens economically? That new, free infrastructure attracts merchants, scholars, and trade to that specific district.
Oh, I see.
Right. The local economy booms. The workforce becomes healthier and highly educated. And because that family likely owns adjacent commercial businesses or agricultural land in that same region,
The value of all their stuff goes up.
the value of their remaining assets skyrockets due to the economic ecosystem they just subsidized.
That is wild.
Furthermore, they have built immense social capital and loyalty, which protects their enterprises during times of political instability. The money didn't disappear. It was deployed as an economic engine that elevated the entire community.
Which in turn elevated the family's enterprise.
Exactly.
That is fascinating. It's essentially the ultimate form of long-term civic investment.
And that's the point the manifesto is making about the modern investor. Practically, it means your personal wealth strategy must have a structured giving component built into its core.
Right, it can't just be an afterthought.
No, it cannot be an afterthought at the end of the year if you happen to have some extra cash. The mandated zakah, which actually taxes idle wealth, by the way, forcing capital into productive circulation.
Right, pushing the lazy money to work.
Exactly. That and voluntary giving must be an active capital allocation.
So what does this all mean for the psychology of the investor? Like, how does this change the way you handle your portfolio day to day?
It creates a profound psychological advantage. When your naya, your core intention, is fundamentally aligned with creating a benefit beyond yourself, your risk tolerance becomes far more rational.
Because you aren't just greedy for a quick buck.
Exactly. You stop chasing quick, volatile, speculative returns because your timeline has shifted. You are no longer thinking in quarterly earnings reports. You are thinking in decades and even generations.
Wow.
The source emphatically states that this is not a soft skill. Long-term time preference is one of the most sophisticated competitive advantages available in finance. Yet almost no one in the West uses it deliberately as part of their structural strategy.
It totally reorients the goal of wealth itself.
Which really brings us to the ultimate synthesis of this entire manifesto. The source argues that the true goal of escaping the lazy money trap isn't just affluence. Affluence versus influence.
Right. Affluence is just the accumulation of capital for its own sake.
Yeah.
Buying the nicer car, upgrading to the bigger house, just having a larger number on your phone screen, that is a dead end, and it's ultimately fragile.
Very fragile.
The actual goal is influence.
Yes. Influence is operational power.
Yeah.
It is the ability to protect the vulnerable in your community. It's the ability to fund the big ideas and the startups that align with your values.
It's building the Ottoman market today.
Exactly. It's the capacity to build institutions like modern WAFs that will stand and serve the public long after you are gone. But to have that kind of influence, you need capital.
Right.
And to protect and grow that capital in a fiat system, you need a rigorous strategy.
You cannot build a hospital or fund a massive community initiative or lobby for your rights with cash that has been eaten away by inflation for 20 years in a checking account.
You really can't.
You have to treat your money with the exact same seriousness that the most successful sovereign funds in the world do. You need the defense of scarcity assets. You need the offensive equity in real infrastructure growth. And you need the active, circulating engine of the Baraka factor.
And as the source reminds us, the entities in the Muslim 500 didn't start out with infinite resources.
That's a great point.
Those sovereign funds and historic families started with these exact same principles applied consistently across very long horizons. The architecture scales, whether you are managing $1 billion or trying to figure out what to do with $10,000 of lazy money.
It applies to you either way. Now, before we wrap up, we do need to clearly state that today's deep dive is strictly for educational purposes.
Yes, very important.
We are analyzing the strategies outlined in our source material, but any actual financial decisions you make with your own capital should always be done in consultation with a qualified Islamic finance advisor and a certified financial planner.
Absolutely. The mechanics we've discussed are complex, and individual execution requires professional guidance.
For sure. But the core principles we've explored today, they challenge the very foundation of how most of us interact with the banking system. It completely shatters that illusion of safety we talked about at the very beginning of the show.
It really does, which leaves us with a critical structural reflection.
Okay, let's hear it.
We started by exploring the invisible war of inflation and the illusion that idle money is safe money.
Right.
Consider this. If inflation is silently transferring wealth from those who save cash to those who own hard assets, your idle money isn't just evaporating into thin air.
It's going somewhere.
Yes. By sitting in that zero yield account, it is actively subsidizing the liquidity of the very financial systems you might be ethically trying to avoid.
Oh, wow. That is heavy. So if wealth truly is an amana, a sacred trust meant to serve your community and outlast your own lifetime, the question isn't just what legacy you are leaving behind. The real question is, whose legacy is your lazy money accidentally funding right now?